Hello and welcome to Business Incorporated, coming to you live from our Lagos studios. I'm Chibibeze Obi Iwago. On the show today, Mauritius Central Bank overhauls its Monetary Policy Committee, delays rate decision. South Africa sells $2 billion of bonds in oversubscribed deal. Plus, World Bank sees Uganda growth at 5.5%. Let's get the show started now with the markets. And here in Africa, South Africa's JSE index was trading in the green at intraday as investors anticipate the Reserve Bank will keep interest rates unchanged next week, as an anticipated quicker rise in consumer prices over the coming months won't drive inflation above target. The index was 1.11% as at midday. The NSE index was down 0.10%. Egypt was down 0.24%. And Kenya closed in the red on Tuesday. In the Middle East, Qatar Stock Exchange was the only winner at intraday as Qatar April inflation falls near zero as food price rise slows. Qatar Petroleum invited firms to bid for new petrochemicals complex. The index was up 0.32%. All the other markets were in the red. Looking at the numbers, Abu Dhabi was down 0.07%, Dubai down 0.18%, and Saudi Arabia down 0.83%. Moving now to Europe, where the market hovered around the flat line in early trade as investors monitored surging interest rates in the bond market. For details, let's bring in Daniel Coop to tell us more. Hello, Daniel. Good afternoon.
Yeah, good afternoon to you, Timmy. Hi from Frankfurt.
Our investors were monitoring the bond market after the yield on the 10-year sovereign rose to 3.09% on Tuesday. That's the highest in 7 years. How much impact has this had on the equities market so far?
Yes, Jimmy, we have seen an impact. Let me try to unfold this for you. This is a very complex topic. That you mentioned, bond prices fell, sending yields to their highest level in almost 7 years. The pickup in bonds yields followed a report showing a solid increase in U.S. retail sales last month. And yes, this is the highest level since 2011 for the yield, which is used to set interest rates on mortgages and other kinds of loans. The surge came after the Commerce Department said retail sales climbed by 0.3% in April, and suggesting that spending by consumers is rebounding as expected after a weak first quarter. Bond yields tend to rise when investors expect faster economic growth and also a higher inflation rate. The rise in bond yields helped lift shares in banks, which benefit from higher interest rates on loans. Wall Street's main indexes slumped last night, with investors concerned that rising bond yields would hurt stock valuations. The dollar rise also helped push down gold to its low point for the year. Let me tell you, there's also another topic here on the Frankfurt Stock Exchange and also on the mind here of European investors. We have to remember that Italy is going through a very difficult time at the moment. Forming a new government there is very difficult. New elections are also a possibility, but also that there could be an anti-EU party forming a new government. They have now said that they want to ask the European Central Bank for a big relief of Italy's debt. This idea, of course, is not popular at all here among investors at all. It reminds them of the situation that we have seen in the past also happening with Greece. The question is also why Italy would even need it. It is the fourth biggest economy here in Europe. The GDP growth of Italy that was released yesterday was actually at the same level with Germany, at a level of 0.3%. Some are saying that a country like Italy should have enough energy and also possibilities to deal with their debt. But yes, this is making investors here a little bit concerned at the moment.
Now, talking about politics, let's look at the controversial discussions in the German parliament today, talking about the budget. What were the key messages?
Yeah, usually when we have those budget discussions taking place in the German Bundestag, that's the name of our parliament, they also use this kind of discussion to bring up other topics. And there were lots of topics on the agenda. Germany's Chancellor Angela Merkel defended the Iran nuclear deal following its rejection by Washington, arguing the pact is the best way to tackle concerns about Tehran's role in Syria and its ballistic missile program. In a wide-ranging policy speech to the German parliament, the lower house of the parliament, the chancellor, now 12 and a half years in office, addressed a range of individual issues from Eurozone reforms also to digitalization and defense, without giving a cohesive strategy vision. Also, a topic was, and Germany has been criticized for that a lot from the United States, that Germany is not spending 2% of the GDP for the military. This was also a big discussion point there throughout the parliamentary session that is actually still underway at the moment.
All right, let's look at the oil markets. The IEA said in its latest report that potential oil supply disruptions in Iran and Venezuela have led traders to shift their attention to geopolitics rather than fundamentals. Now, is this a trading topic for the markets today?
Well, the oil price is certainly always a trading topic here, also on the trading floor. Also, individuals, we have really seen with this tension now between the United States and Iran, possible sanctions, that the prices here at gas stations have been going up. Venezuela, another big oil producing company, their crude production hit a 33-year low in the first quarter, down 28% in 12 months. The refineries are operating just at a third of their capacity, and its workers are resigning by thousands over there, a country that has been in a crisis now for a very long time. And yes, this is a big topic here on the stock market. We really have to see how all of this now is going to unfold with Iran. Also we had Saudi Arabia announcing that they want to increase their oil production. There are lots of question marks which effect all of this is going to have on the oil price. That certainly is still set to go even more up.
We'll get some of those answers as the week rolls by. Thank you very much for your time, Daniel. Move on now.